Welcome back to the Daily Crypto Deep Dive. Today we're going to talk about a headline that didn't just move a chart, it moved the conversation. Ripple, the company behind XRP and one of the longest-standing survivors in this industry, has just closed a $500 million funding round at a $40 billion valuation. You might have seen the headline flash by and thought, big raise, interesting. But what happened here is much bigger than another capital injection. The people writing those checks aren't crypto natives or speculators. They're the names that build and fund the modern financial system. Fortress Investment Group, Citadel Securities, and several undisclosed sovereign wealth funds from the Middle East and Asia. When those names move into a crypto company, it's not because they're chasing hype. It's because they see strategic alignment. And that's the signal we're going to decode today. What this raise means for Ripple, what it says about where institutional capital is going, and why this moment quietly confirms that the next phase of crypto isn't about speculation, it's about infrastructure. The timing couldn't be more poetic. Just 3 years ago, Ripple was fighting for survival. The SEC lawsuit, the delistings, the headlines calling it finished, it all looked terminal. But while most of the industry was licking its wounds from the FTX collapse and the Celsius implosions, Ripple spent that time building the most boring, durable, and therefore powerful part of crypto, and that is the plumbing. And now, as the industry matures, the plumbing is exactly what institutions want to own. The number itself, $500 million, is impressive, but the more telling part is who led it. Fortress Investment Group manages more than $45 billion in alternative credit, distressed assets, and infrastructure. They don't gamble on fads. They invest in toll roads, rail systems, and utilities, things the world needs to keep running. Citadel Securities, on the other hand, is the backbone of modern market making, responsible for roughly 1 in 4 U.S. equity trades. These are not risk-on tourists. They are liquidity architects. And now, they're buying into Ripple. Jamie Coutts at Bloomberg Intelligence summed it up perfectly. This isn't about a speculative bet on XRP. This is about positioning for tokenized payments infrastructure. Ripple isn't being valued like a crypto company. It's being valued like a future clearinghouse. That line, future clearinghouse, is the key. Ripple's strategy for years has been to bridge traditional finance and blockchain through real-time settlement technology. While others chased retail trading, Ripple built partnerships with banks in Japan, the Philippines, the UAE, and Brazil. Its on-demand liquidity network now touches more than 70 financial institutions. And what this raise does is give Ripple the dry powder to scale that globally. Adding corridors, expanding into tokenized FX markets, and integrating with institutional custody systems. Weston, head of research at Pepperstone, called it the final phase of crypto's adolescence. In his words, when Citadel writes a check into blockchain payments, that's the equivalent of the first major banks joining the internet in the 1990s. It's the legitimization moment. Let's be clear. This isn't the kind of raise you do when you're experimenting. This is strategic war chest capital. Ripple isn't raising to survive. It's raising to dominate the layer between fiat and blockchain. The settlement layer. Now think about the timing. The broader crypto market has been steadying after a volatile week. Bitcoin is hovering above $103,000. Ethereum sits comfortably in the mid-3,000 range, and risk appetite is quietly returning. Against that backdrop, this announcement lands like a reassurance bell, a reminder that institutional money is still flowing, just not into memes or speculation. It's flowing into infrastructure. Noelle Acheson, former head of market insights at Genesis, and now an independent strategist, wrote earlier today, "The investors in Ripple's latest round are effectively buying into the next monetary rails. Fortress and Citadel aren't seeking yield. They're securing influence over how digital value moves between institutions." That's a stunning way to frame it, because it reframes Ripple not as a company, but as a protocol for money movement. Something that could rival SWIFT, correspondence, and even parts of VisaNet over the next decade. When you zoom out, it fits a pattern. Every major crypto cycle begins with infrastructure bets. In 2018, Coinbase raised Series E money from Tiger Global. 6 months later, the market turned. In 2023, BlackRock filed for its Bitcoin ETF. 6 months later, liquidity flooded in. Now in 2025, Citadel and Fortress have anchored a funding round into Ripple. The question is whether this is the quiet ignition of the next institutional leg. The most interesting part, though, isn't Ripple itself. It's how this move sits in a wider institutional playbook. Citadel Securities has been actively building its digital asset trading infrastructure since 2023. Fortress has exposure to fintech rails, private credit settlement, and even tokenized treasury platforms. In other words, both firms were already circling the blockchain perimeter. This round is the moment they stepped inside the fence. Galaxy Digital Research commented, "This deal validates the thesis that the next generation of financial infrastructure will be built on permissioned public blockchains. Ripple is positioning to be the bridge between compliance and settlement efficiency." And that's the new magic phrase: permissioned public blockchains. Systems open enough for interoperability, but structured enough for regulation. It's exactly where the institutions are most comfortable operating. We'll take a short pause here. And when we come back, we'll dig into how this one deal could quietly kickstart the next institutional bull run, and what it tells us about the future of blockchain finance.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
So how does $500 million flowing into Ripple ripple out across the rest of the market? It starts with perception. Institutional investors care less about short-term prices and more about validation. Every time a marquee name writes a check into crypto infrastructure, it de-risks the entire asset class for the next wave of entrants. Look back. After BlackRock launched its Bitcoin ETF, pension funds that had never touched digital assets began allocating small percentages. After Fidelity built custody, insurance firms followed. These milestones form what analysts call the legitimacy cascade, a chain of endorsements that gradually turns fringe technology into mainstream allocation. Ripple's round could easily be the next link in that chain. Jamie Coutts described it as the institutional put option for crypto, meaning that large players now have skin in the game to keep the ecosystem functioning. If Ripple's network succeeds, banks, funds, and payment firms benefit. That alignment of incentives stabilizes the industry in ways retail speculation never could. Another key impact lies in tokenization. Ripple has quietly been working on bringing tokenized assets, from treasuries to commodities, onto its ledger. The raise funds the expansion of its RippleNet infrastructure to support real-world asset custody and on-chain settlement. It effectively positions Ripple to compete with JP Morgan's Onyx platform, Goldman's digital asset pilot, and Circle's USDC ecosystem. Chris Weston noted, "What you're seeing is the birth of an arms race for real-world asset tokenization. JP Morgan's Onyx, BlackRock's Bwiddle Fund, and now Ripple's liquidity network, all aiming to tokenize trillions of dollars in idle financial instruments." And that's the quiet subtext. Ripple's funding is not about chasing crypto users. It's about capturing the global flow of institutional money that's already digitizing behind the scenes. According to Boston Consulting Group, more than $16 trillion worth of assets could be tokenized by 2030. Whoever controls the settlement rails for that market will effectively own the backbone of future finance. Noelle Acheson emphasized this in her newsletter. Ripple's new capital base gives it the scale to integrate with central bank pilots and private market settlement layers simultaneously. That's a convergence point we've been waiting for. Now let's think tactically. How does this shape market structure? The immediate effect is likely sentiment uplift around utility coins and infrastructure tokens. XRP, which tends to lag on news, might not moon overnight, but over the next quarters, institutional narratives will lift it. Beyond XRP, coins tied to payment and settlement, Stellar's XLM, Circle's USDC governance, even Chainlink's cross-chain data, will all benefit from renewed interest. But there's also a broader psychological effect. When retail traders see Citadel and Fortress moving in, it signals safety. It says, the adults are here. That changes risk perception, and risk perception is the lifeblood of capital inflow. Let's also not ignore regulation. Fortress and Citadel can't deploy $500 million without compliance clearance. That means this deal likely underwent deep conversations with US regulators, the UKFCA, and possibly MAS in Singapore. The implication? Regulators are now comfortable enough with Ripple's structure and compliance standards to let traditional giants participate. After years of legal limbo, that's a quiet policy victory. Galaxy Digital's team framed it this way. FTX was the death of unregulated speculation. Ripple's raise is the birth of regulated infrastructure. It's a passing of the torch, the end of crypto's adolescence and the start of its institutional adulthood. So could this deal spark the next bull phase? Historically, big capital moves like this precede broader market inflows by 6 to 9 months. The reasoning is simple. Funds allocate privately before they allocate publicly. Once infrastructure rounds close, ETF flows and secondary market demand tend to follow. That's what happened after Coinbase's 2018 raise and BlackRock's ETF filing in 2023. If that pattern holds, Ripple's raise could be the quiet ignition for 2026's expansion phase. Chris Weston put it more bluntly. Infrastructure money is always the canary in the coal mine for the next cycle. When you see it flow, it means the people who actually manage risk think conditions are investable again. And this time, the scale is far larger. We're not talking about 100 million checks from crypto funds. We're talking about Fortress, Citadel, and sovereign wealth allocations that could expand Ripple's liquidity corridors into new jurisdictions. That opens the door for the first true global blockchain settlement network. Regulated, liquid, and institutionally backed. From a macro view, this also feeds into the wider story of de-dollarization and payment modernization. Many emerging markets are looking for systems that reduce dependency on SWIFT and dollar rails while maintaining interoperability with existing finance. Ripple, with its regional partnerships, could become the neutral bridge currency layer that handles real-time cross-border settlements. That's not speculation, it's strategy. Noelle Acheson pointed out something subtle but powerful. The biggest misconception about Ripple is that it's competing with crypto. It's not. It's competing with legacy banking. And that competition might actually accelerate because the same institutions investing in Ripple, banks, hedge fund groups, and liquidity providers, are the ones most likely to use its network once it's built. That's the classic platform flywheel. Investors become users, users become evangelists, and adoption becomes inevitable. In practical terms, expect Ripple to expand aggressively through Asia-Pacific, the Middle East, and Latin America over the next year. Fortress already has credit operations in those regions. Citadel provides liquidity there. The deal gives Ripple both funding and built-in distribution. Now step back and look at the broader chessboard. You have BlackRock anchoring ETFs, JP Morgan pushing Onyx, Circle driving stablecoin adoption, and now Ripple securing institutional payments. Each piece fills a missing gap in the financial crypto fusion. What we're seeing is the architecture of a hybrid global system. Traditional in regulation, blockchain in execution. That's why Jamie Coutts said this week, this deal closes the loop. We now have end-to-end institutional rails for custody, trading, tokenization, and settlement. The infrastructure phase is complete. Now comes utilization. That's where the next trillion in value will come from, not from speculative pumps, but from throughput, transaction volume, and cross-border integration. So while traders are arguing over candles, the future of money movement is being built quietly, methodically. And now, with $500 million of fresh fuel, at full throttle. If you're looking for the takeaway, it's this. Every industry matures when infrastructure wins over speculation. In the early days of the internet, people invested in websites. Later, they invested in servers, data centers, and bandwidth. In crypto, the same evolution is happening right now. The capital is flowing away from volatility and toward utility. Ripple's raise is proof of that pivot. This is not the Wild West anymore. It's regulated frontier territory, and the biggest institutions are planting their flags. The ripple effect, no pun intended, will be slow but powerful. First comes credibility, then liquidity, then adoption. And this raise is the starting gun for that sequence. If you're listening on Spotify or Apple, make sure you're following the show and drop us a 5-star rating. It helps push crypto journalism further up the charts. Drop your thoughts in the comments. Tell us what you think this deal means for the future of global payments. And as always, we'll see you at the top.